What's up, guys? My name is Mike Sharp. This is Sharp Investing, and this is Flow Traders Q2, but by popular demand. I wasn't going to do a video, but got a lot of requests, so here I am. And I'm a little bit annoyed because I recorded this already, and then the sound broke on that video. So I'm going to try and do this quick. And if I miss anything, just message me, and I'll try and answer it. But we'll just go over the high-level stuff. I'm not really going to go into the details of the quarter. But there's some key things I wanted to touch on. Okay, so I have a question for you. Let's say you don't own this business and you didn't know what I was talking about, and I said to you, I have a company that has 40 to 50% EBITDA margins, 25% net margins kind of on average, a 20 to 25% return on equity, no cash flow losses over any quarter for the last, 9 years, 10 years. What would you pay for a business like that, and one that is growing their equity at that same rate of ROE? So we expect equity to double in 3 to 3.5 years, which means, and earnings are built off the equity. So we expect earnings to double in 3 to 3.5 years. What would you pay for a business like that? And I would personally probably pay at least 20 times earnings. It's also in a developed market jurisdiction. This isn't like emerging markets, Kaspi, Kazakhstan stuff. This is just stable market, stable country. I'd say it's worth at least 20. We're looking at, for Flow right now, we're looking at a valuation of below 10 times normalized earnings, probably more like 8. And so I think this is significantly undervalued in terms of what I would pay for it normally. And then the question becomes, is the thesis here that this valuation gap is going to close at any point? And I think the answer is no. Weren't expecting that, were you? So this business is, I did a video about like lumpy earnings versus smooth earnings. I think that was the title. And I think there's a big premium placed on smooth, predictable earnings, and Flow does not have that. We don't know when the money's coming in, but it always seems to come in. So the question is, do you want a smooth 10% or a lumpy 20%? I'll tell you which one I want, and my money is showing what I want. I would like the lumpy 20%. I'm happy to not really know what I'm going to make next quarter, and Flow provides that. But basically, the thesis here is that if you don't know the thesis, I suggest going back and watching some of the videos, particularly the one after they changed the capital allocation policy, which was last summer, I believe, about a year ago now. So I'll go back and watch that one. But basically the idea here is that they're taking all their earnings and pumping it back into trading capital, which then allows them to expand their revenue because their capital is directly related to how much net trading income they can produce. So they are turbocharging the capital expansion of this business, and I expect that, like I said, it's going to double every 3.5 years, given this the current rate that they're running at. And so what am I doing with my actual stock? I actually sold some at 27. So what I do is I rebalance this holding a lot. I know how the market. I think I know how the market behaves around their earnings. When the market expects earnings to go up in the near future, like this quarter, next quarter, then the price will get pushed up, which is what we've seen this year in the first half. And then as the market sort of sniffs out, well, there's lower volatility coming, and the earnings aren't coming in over the next 3 to 6 months unless there's a problem. The price comes down because people are not patient, right? So I think we're in the phase where it's starting to come down now. But if it gets down to 20, I'll add back to my position. Like as it went to 16, I think last year, I really loaded up on this one. And then as it got to 30 and then seems like it got stuck, I unloaded a chunk of it at 27. So I'm just playing the rebalance game. I have a certain amount I want to invest in Flow Traders, and if it goes up, I cut to that level, and then if it goes down, I add to that level, right? So it's pretty easy game. It seems to be working well for me so far. All right, So the big news here is, before we go into the quarter stuff that I'm going to touch on, Thomas Spitz is the new CEO. He didn't really say anything, and he hasn't really put out any information as far as I know. Maybe I'm missing it. Let me know if I missed something. But basically, the thing that I was worried about was that they changed the business plan here. And given the what they wrote in their press releases and what Mike Kuhnel said, basically they're gonna continue with the capital allocation, or the trading capital. What is it? Building? I forget what they called it, but basically the strategy I was talking about, where they just build the trading capital by pumping all earnings back in and potentially get more debt on board to juice their earnings. So they seem to want to continue with that, and that's the big thing that I cared about, which is great. And so then Thomas Spitz can go and sort of add on top of that, which is potentially good news. But we'll have to wait to see what his plan is and what he's going to change or what he's going to add to the process. I don't have enough information now to have a guess whether this is going to be good, but the key thing is still in place. Potentially no dividends, no buybacks, just piling up the trading capital. All right, so let's look at Q2 real quick here. Total income for the half is $279. Actually, they didn't make as much money as I thought they were going to make last quarter. I thought it was going to be more than this. It was a good quarter. We see they made $118 in earnings, and for the half it's $201. So that's still a really good half. I mean, if the second half looked like that, you could see how cheap the stock is. I don't think it's going to be like that in the second half unless we get another meltdown from Trump or something else. But that's a good start to the year. It means they're making a lot of money. Not much else to say there. Actually, the EBITDA margins, you can see this year, 47% for the half, really great, versus last year, which wasn't quite as great, still over 40%. So this is a cash cow, this business. Again, I'm not going to talk about anything here. You can see the tailwinds are still cruising along. The ETP volumes are just marching upwards over time. Fixed income, they're continuing to grow. All the markets are growing, especially Asia, which is fantastic. I think that's where the majority of the income is going to come from in the future. And I believe the spreads are wider there at the moment. So that's really good to sort of build your revenue in places where spreads aren't as tight as like in the US, where there's so much competition. So I'm watching Asia particularly right now because Europe is a bit of a pretty developed market, sleepy market, and Asia is the big one for me. High operating leverage, yeah, we already know that. That's why the EBITDA margins are high. Yeah, this is just telling you what we know. The VIX was actually high. That's why, so 21 this in the first half, which is why I thought the earnings were going to be higher. But basically they said that, well, I'll look at part of the reason later in terms of the interest cost, but you know, I think there's some other reasons. I can cut that bit out. Trading capital, this is the key one. So we're up. Trading capital this year is up 33% over last year, so the new plan is working. That is a very fast growth rate. That would double in just over 2 years if they did that consistently. And I'm expecting sort of 20 to 25% going forward, but 33%, great for the first year. Only up 4% over last quarter, so that's not as good, but still pretty healthy. And you can see the ROEs are 26% this year, really great. And when they talk about return on trading capital, just keep in mind that's the gross number, right? So if they're saying 55% return on trading capital, that's the top line, not the bottom line. This is the bottom line number here, the ROE. Okay, so a couple of other developments here. Crypto it did not have a good quarter, right? And I think it's actually adding a lot to their earnings these days. Because like Asia, I think the spreads are wider in crypto. So when crypto is going crazy and everybody's buying and selling, they can make quite a lot of money on that. Now they don't break this out for us, unfortunately, but they did mention that earnings aren't, crypto is a little bit sleepy this quarter, so that's why the earnings aren't as good as expected. They did say that crypto is counter-cyclical, or I guess less correlated to the rest of their portfolio, and I'm not sure that I actually buy that. I think that it was not correlated. Bitcoin held up really well in that Trump, what was it called? The Liberation Day mess. And I don't actually expect that to happen again if there's an actual market meltdown that's not driven by those same types of fears, right? I think crypto and gold held up really well because there's a fear that what Trump's doing is he is destroying the value of the US dollar. So these are hard assets, well, hard, but like they're finite assets that people can hold on to if there's a giant mess on that front. But like I said, if the Qs go down, if QQQ goes down, or the SPY and the market goes down 20% over 6 months, I don't think crypto is holding up in that environment. So I think it's going to be correlated to the stock market just generally over time. They did talk about stablecoins, which is pretty interesting. So my understanding of stablecoins, now don't quote me on this because I don't know it that well, but basically it's a way to, one of the big uses is to send money overseas, transfer money without relying on traditional banks, right? So they can, it makes it more efficient, quicker, like you don't have to send money when banks are open, right? You can send USD denominated stable coin, I think it's like Tether, at any time of the day, and potentially the rake on that is lower, so you're losing less in fees than if you go through the FX market in banks. Now, like I said, I don't really understand it that well, but I think they're smart to get into this space pretty early on. It doesn't cost them that much to expand into this space, and it could be a big winner over time if the infrastructure gets to the point where big companies are using stable coins to transfer money between countries and things like that. So I don't know. I trust the management. I trust Mike's decisions. He decided he wanted to buy all these little crypto companies. I think it was last year or maybe more like 2 years ago. And I thought, oh, that's kind of stupid. Crypto's stupid. Why are we doing that? It's a waste of money. And I think it has ended up paying for itself multiple times over. The amount that they invested versus the income that they've generated on those crypto assets. So again, this could be another big winner. If it's not a winner, they don't lose that much, right? But I think it makes sense to sort of stay at the front edge of these financial curves, just so you don't miss the boat if they leave, if it leaves the dock. What else do I want to talk about? Okay, so final thing, I want to talk about gross trading income versus net trading income. My new friend Josh pointed this out, and I think he made a great point about how we can take a look. You can see sort of a little bit under the hood of how the business is actually progressing rather than looking at net trading income. And I have mentioned this in the past where the interest cost on their trading is really influenced by the interest rates. So it can mask some of the good stuff that's happening underneath the hood, right? If we're all just looking at net trading income, which is what they promote in their documents, in their presentations, if we're looking at that, it might give us a bit of a distorted view of how the business is actually doing. So let's take a look here. I'll just show you a few years here. For example, I don't think they produce it on a quarterly basis, but if we look at the annual statements, right, you've got 542 million in gross trading income in 2021, 677, and you can see that the financial expenses has gone up considerably there, and that's when all the central banks started raising rates, right? You have your trading fees here, which we can ignore because those are, I think those are pretty stable in terms of a percentage of gross trading income. But if we look at the financial expenses, they almost doubled there, and that wasn't even done the hiking cycle there in 2022. So the net trading income looks a bit closer than the gross trading income does, and you can see them growing the business underneath the hood. If we look at 2023, this is a low year in gross trading income because the VIX was so low. It was a very uneventful year in the markets, so they didn't get a huge amount of opportunities, but you can see the financial expenses are just exploding here, right? So that's almost 3 times what it was in 2021, So we might erroneously conclude that that was a bad year, but you can see that even on a bad, like a very low vol year, the gross trading income is still pretty healthy, right? And then we look at 2024, a good year back up to 800 million. And again, the financial expenses are going up. Now, I don't really think I don't think financial expenses are going to go back down to 2020 or 2021 levels. Actually, I'll show you a little spreadsheet I did just to kind of get an idea of this. So you can see 2020 or 2019 all the way through 2025 annualized. This is the gross trading income, which is the blue line here. You can see it sort of marching up over time. If you ignore that anomaly year in 2020, where everything went berserk, I've got trading fees, financial expenses, net trading income, and then this is gross trading income less financial expenses, right? So that ignores trading fees, I think. Is that right? Yeah. Okay, so but the key thing here is that this is the financial expense versus gross trading income, right? You can see that like in 2023, it's a huge percent of the gross that went to financial expenses, 30%, whereas now we're back down to 16%. So we're in a more normalized environment. And 2020 was extraordinarily high at low at 5%, right? So very, very little of the income went to financial expenses. But you can see over time here, this is the key part. So net trading income is yellow. And basically, we want to follow the blue line. It looks like they're building the business pretty consistently over time. So I just wanted to give you an idea there of what I'm seeing. And I think that's probably it for this video. I would leave it to you to go through the quarterly results and pull out anything else that you think is interesting. But my bottom line is that new CEO looks like he's going to keep the trading capital expansion plan in place, which is the key thing for me. And I can just leave this business and let them compound my money for the next 5 to 10 years. Thanks very much. Catch you in the next video.